Hi, my name is Ujat and welcome to Rock with Option, a show for all your option needs. In our previous episodes, we spoke about how to use PCR, put call ratio, in assessing and predicting market movements and thereby helping us to buy options. If you missed that video, do click on the link above. Today, we're going to focus on another parameters that can help us in buying options, FIIs derivative data. In this video, we're going to look at how FII derivative data influences the market and how we can predict market movement with this data set. This will in turn help us buy options to take advantage of that market movement. There are two ways FIIs can make investment into the Indian market. First is the equity space, second is the futures and options space, the FNO space. The inflows, the fund inflows and outflows into the equity space is captured under the cash data. I mean, most of you must be familiar with it because most media channels focuses on this particular data. Whereas all the inflows and outflows into the FNO space is captured under the derivative data. If you see the trend, the inflows and outflows into the equity space has an influence on the market more from a medium to long term perspective. However, derivative data, especially the future data, has a very strong impact on the market in a very short term. Here, FIIs are directly betting on the movement of the stock market. Remember, this is a leveraged bet. So it is this data that we're going to focus on and evaluate and see how we can take advantage of the trend in this particular data to predict market movement and take advantage of it. So where do you find this FIIs derivative data? As you know, most media channels focuses more on the cash data, and FIIs derivative data is not actively discussed or published. However, NSE has all the information that any retail investors would like to have. So if you go to under all reports under derivatives, you will find an FNO participant wise open interest. This will provide all the necessary information with regards to FIIs inflow and outflow into the derivative space. If you don't want to do the hard work, you just follow me on Twitter. I provide all the necessary information and also talk about opportunities that arise from FIIs derivative data. Now let's look at what is the analysis that we're going to do and how do we get to this analysis. As I told you previously, from the NSE website, once you download the Excel file, you have all the information with regards to FIIs inflows and outflows into the derivative space. We're going to focus more on the open interest in the index futures. As I told you, this is very critical because this is where FIIs are directly betting on the index, and this has a significant impact on the movement of index in the short term. In the Excel sheet, you will find the index long contracts as well as the index short contracts. Then we go and calculate FII's long exposure, which is obtained by dividing index long contracts by the total OI. That is, we sum up all the contracts, both the long and the short contracts. So we divide the index long contracts by all the contracts that is there in the system. This gives us the FII's long exposure. So once we have calculated the FII's long exposure, how do you interpret this data? If the FII's long exposure is between 25 to 75%, it's a neutral zone. It's a no trade zone. This is where the market is more in the equilibrium and could move in the positive or in the negative direction. However, if FII's long exposure falls below 25%, the market is in the oversold area. From here, you can expect a bullish trend reversal. If the FII's long exposure is greater than 75%, then we have moved into an overbought area. From here, the market is expected to do a reversal. We can expect a bearish trend reversal from these levels. Now let's look at the mechanism. Let's talk about the mechanisms. Now we have broadly understood how to use the FIIs long exposure. Now let us talk about the mechanisms. We're going to use an example of the market moving into the oversold area, and we're going to discuss how do we enter and take advantage of this particular trend. So when do you say the market has now moved into oversold area? When the FIIs long exposures drops below 25%. From this levels, we are expecting a bullish trend reversal. A trend reversal will help the FIIs long exposure move back into a more neutral range, that is between 25% to 75%. We believe buying call options during these times yield some really good results. What call options to buy? It's always preferred to buy closest at the money call options. Always ensure that there is enough liquidity for the option so that the pricing is more accurate. Since since for the reversal it could take maybe 2 or 3 days, it is advisable to buy monthly option contracts or weekly contract options, which is going to expire 7 to 10 days away. Now that we have entered a trade, now let us discuss about the mechanisms to hold the trade and when to and the exit criteria. Remember, the market was in the oversold zone, FII's long exposure was in the oversold zone, and we're expecting a bounce back. We're expecting a bullish trend reversals from these levels. When that happens, not only the Nifty moves up, we are also expecting the FII's long exposure to move from below 25% to a more neutral zone, that is between 25 to 75%. So if or as long as FII's long exposure is steadily increasing along with the Nifty spot, the bullish trend is intact and we hang on or hold on to our trades. When the long exposure, FII's long exposure starts declining, this usually happens when Nifty is near that resistance level. When that happens, it's a bearish indication, and that is where we exit the trade. So in summary, FII's long exposure is a very good metrics to assess the sentiment in the marketplace and predict short-term market movements. If you're an option buyer, adding the FII's derivative data to your trade mechanics will enhance or significantly enhance your profitability. I hope you found this episode interesting. If yes, do subscribe to us. Till we see you next time, trade small, trade often, and more importantly, trade happy.